Today I'm going to show you how you can trade synthetic indices using RSI divergence and price action pattern, a very simple price action pattern called the engulfing pattern or the engulfing candles, and I will show you what they are as you go on with the examples. So I'll just give you a step-by-step process for this, and I'll just type it here. So first of all, I love this strategy because it is a very high risk to reward ratio strategy and a very high win rate strategy, where you can get even up to 70% win rate and a risk to reward ratio of 1 to 4R or 1 to 5R. So the first step is you want to have wait for the formation of RSI divergence, either bullish for buys or bearish for sells. And then the second step is after the formation of the RSI, actually the formation of RSI divergence is marked after the formation of engulfing pattern. So this one is marked by the formation of an engulfing pattern. Then the next step is wait for the close of the engulfing pattern and take an entry I'll just define the entries, the stop loss, and take profit and entry thereafter. So it's a very simple trading strategy. And now for the next thing I want to do is to show you the RSI settings. These are the standard or basic or default RSI settings that you don't need to even modify. For example, you can see length is 14 and 70 and 30 for your levels. You don't need the middle line, so I remove that, and this is just as it is. So this is good if you're taking intraday trades and maybe a bit of what do they call it, this where you hold trades over a few days, swing trading. So you can do that. If you want to take scalping trades, you can reduce the RSI length to maybe 7 or even 4 if you want to take scalping, but it has to be in a lower time frame, such as the 5-minute time frame or the 1-minute time frame. So now let us come to the definition of the RSI divergence. Now when you have price forming lower lows and lower highs, lower lows and RSI is doing the opposite, that becomes a divergence. I'll give an example. For example, now in a typical scenario, we expect that when price is forming a higher high and a higher lower, a higher low and a higher low and a higher high. For example, here, this level here, you are expecting that RSI is also doing the same thing. You can see that higher low, higher high, higher low, higher high. But then there are instances when price is forming a higher low and a higher high, but the RSI is doing the opposite. Let us get an example for a bearish scenario. So let me see if you can get here. Let's use this one. So you have price forming lower highs, higher lows and higher highs like this, but RSI is doing quite the opposite, and I'll show you right here. So you can see price is doing quite the opposite. So higher lows, higher highs, but price, the RSI divergence, the RSI is doing higher highs and higher lows. So this means that this has formed a divergence like that. Let us look at a bullish example or a bullish RSI divergence. When you have RSI doing lower lows and lower highs, but RSI is doing the opposite, and a typical scenario is when price is forming lower lows and lower highs, we expect RSI to be doing the same thing. For example, here a lower low and a lower high, but yeah, and RSI is doing the same thing, lower low and a lower high. You can see that. But in some cases, you will have price forming a lower low, but RSI is doing the opposite, lower lows and lower highs. You can see that. So when this is happening, this becomes a divergence, and it is a signal. A divergence, these divergences are a signal of price reversing in the direction you expect it to. For example, we are forming a bullish RSI divergence, and now as a result we want to see price moving higher. As you can see, it moved higher. So at what point do we introduce the engulfing patterns? Engulfing patterns are just a confirmation of price going to move in the direction we anticipate it to move. So let us look at an example that I saw here. So you can see here we had price forming lower highs and lower lows like that, and then the RSI was doing the opposite, giving us a lower low and a lower high like this, right? So when you have this divergence, this right here is formed after price has given us a bullish engulfing candle. Now we define what an engulfing pattern is. So you can see that we have a bearish candle and then a very massive bullish candle that closes above the opening price of the previous bearish candle, and that means that this is a bullish pattern, or a bullish engulfing pattern, or a bullish engulfing candle. After the formation of a bullish engulfing candle or pattern, and we have a bullish RSI divergence, this is a signal for us to get into an entry, and this is what we have here. So after the close of this engulfing pattern or candle, you want to take a trade here immediately after that candle closes, and stop loss below this engulfing pattern, and this engulfing pattern includes this low here. So you want price the stop loss to be just below it, and then you want to get a risk to reward ratio of 4R or 5R, or you can alternatively use market structure to get your take profits. So you easily got 4R at this point, around here, around there, you can see, and you can take a 5R at this point right there. Or if you choose to use market structure to get your take profits, you can take your first take profit here and your second take profit here. And second take profit at this level. And when you look at this, you see you easily got almost a risk to reward ratio of 11.27R. Now, a reason why I have this engulfing pattern as my confirmation is because it does two things for me, actually three things. Number one, it gives me a stop loss level. I do not expect price to retrace beyond this low here because we have a very strong bullish engulfing pattern. Now, if at all price comes and closes below this level, then it has invalidated our setup, and that makes this stop loss very good enough and very tight enough so that you don't lose huge amounts of money when you're taking the trades. And then the second thing it does is it gives us a very high risk to reward ratio type of trades. For example, a typical trade will maybe a trader will take a 1 to 3 or a 1 to 2.5R, which is not a bad thing. But with this kind of setup, you can easily target 1 to 4R as a minimum risk to reward ratio, or 1 to 5R as a very sweet spot, and maybe use your market structure for take profits like that. The third thing it does for us, enables us to get into trades that can easily be turned into what do we call them? We call them full margin trades. imagine if you got into a full margin trade at this point, you would have easily flipped an account from maybe $100 to $1,000 if you're risking the entire $100. You can see this is a risk to reward ratio of 11.28. If you entered full margin on V25 index, here you can easily get $1,000 out of 100. So it becomes a very easy setup to take full margin trades. Let us look at a bullish at a bearish RSI divergence with a bearish engulfing pattern. I will remove the 7 drawings and then we look for a bearish engulfing pattern, and I think we can see one right here. This was a good one. So you can see we have price forming a higher low and a higher high, and RSI is doing the opposite. You can see that. Now this is marked, this opposite movement on RSI is marked after the close of this, after the formation of this bearish engulfing pattern or candle layer. And as I have said, when you have a bearish engulfing pattern like this is a sign for reversal, and your stop loss will be here if you will get into an entry like this. So the reason why I say it should be slightly above is because we have these kind of things happening. So now after the close of this candle or this bearish engulfing pattern, that is now when you get into a sell trade like that. Stop loss, it's a very tight stop loss just above this high of that engulfing pattern, and you want to target risk to reward ratio of 4. You can see we easily got to 4R very fast for this trade. 4R like that, you can see that with minimal retracement, or 5R, you can see 5R around there. Or you can alternatively use market structure to get your take profits. For example, this is your final take profit, this is your first take profit, and this would be your second take profit. Actually, you can have 3 take profits or 4 take profits here. This can be the first one here. You can see that. So the first take profit, second take profit, third take profit, and fourth take profit. This relative equal lows here. And if you're to hold this trade the entire time, what would you have had? You would have had a risk to reward ratio of 13.95R, holding it like that. Now if you were taking a full margin trade on $100, this would easily turn into $1,300 or $1,400 because of 14.04 risk to reward ratio. And that is how easy it becomes to trade these what do you call them, synthetic indices, using RSI divergence and bearish engulfing or engulfing patterns. So a typical RSI trader would have seen that this is in the oversold zone and would have taken an entry probably at this level here, and this would have been a very good sniper entry to a stop loss, right? You can see around where here when price got into the oversold. And this was me some time back. This was me trading RSI without using any other price action strategy or method to take risk to reward ratios, and this is not a defined or predefined stop loss level. You can see that. Yeah, so when you combine this, it becomes very easy to trade these synthetic indices. Now, would you have had such scenarios like this one where you do not have a clearly defined stop loss level, clearly defined engulfing pattern? You can see we don't have an engulfing pattern here, but in the higher time frames, actually this is an engulfing pattern. 3 candles closing bullish, then took the above this previous candle here. That would have been a bullish engulfing pattern. But in the same time frame, you do not want to take a trade there, because we are disciplined enough to know that we only follow our strict rules of a bearish or a bullish engulfing pattern has to form first. Yes, so that is how you would have participated in this price action. Very easy strategy to trade synthetic indices. I have seen it works on V75, V25, boom and crash. Specifically, boom 1000, crash 1000, and crash 500. Specific those ones, and you can try this and backtest them to see if they work for you. But I assure you, this is a very good risk to reward ratio, high win rate strategy you can use to trade synthetic indices, whether you are flipping accounts or you're just managing that account in a simple manner. You will have a very high win rate. I have seen it goes up to around 70% win rate and risk to reward ratio of 4R as the lowest, or a minimum of, or a sweet spot of 5R. Yeah, so give it a try and see if it works for you. Bye bye.